Hello everyone, in this video today we're going to be doing the topic of the definition of cash and cash equivalents. Okay, so first we're just, again, this is basically just going to be some definitions and just kind of some details on these specific items and reporting in the balance sheet. Okay, so first, cash, what is it? It's a company's most liquid asset and it's the basis for measuring all transactions. Okay, relatively straightforward. It includes items such as currency, coins, checking accounts, savings accounts, petty cash funds, certified checks, cashier's checks, bank drafts, and personal checks. Okay, so if you were to see any of these items, you kind of should just go ahead and memorize, okay, these are the items that are considered to be cash, okay? Because if you were to see those, then the professor or the TA or whoever's testing you would expect you to know that these items are technically considered to be cash, okay? Now, and we'll kind of see how that plays into what you would need to do in a problem here in just a few minutes. And then cash equivalents, well, those are short-term, highly liquid securities whose maturity is so near that it is unlikely that its value will fluctuate greatly. So pretty much definitionally, these must have an original maturity of 3 months or less. Okay, so that means that they're just very liquid, right? They're basically going to be traded. They're going to be bought and sold very quickly. So they're close enough to cash that they're called cash equivalents, okay? Because we basically know what the value of them is, and if we wanted to, we could get that amount of value in cash paid to us today, okay? Now, these include items such as commercial paper, money market funds, and treasury bills, okay? And so basically, for cash equivalents, again, just kind of memorize. These are things that would be considered to be cash equivalents, okay, for the exam, okay? Then we have restricted cash. This is cash set aside for a specific purpose, all right? So as an example, a company may set aside cash for a future plant expansion or to pay off its liabilities. Okay, it's just saying like it's cash, right? But it's basically designated, it's earmarked for, okay, we're going to use it for this specific purpose, okay? Now, it's reported in the current asset section if the reason for setting the funds aside will occur within the next year or operating cycle, whichever is longer. But it's reported in the non-current asset section if the reason for setting the funds aside will occur after the next year operating cycle, whichever is longer. So basically, for classifying restricted cash, it depends on why are we setting this money aside. Okay, so if we're setting it aside for something that's going to happen within the next year, it goes in the current asset section. Okay, but if it's after the next year, it's non-current assets. Okay, so that's basically just a note on reporting. How do we report restricted cash? Because it is cash technically, but it's going to be used for a specific purpose. Okay, so we want to kind of match the cash when we report it to its purpose in terms of current or non-current. Okay, then companies must report restricted cash as its own line item on the balance sheet. It must be designated by itself as, okay, this is restricted cash. And then we also have this idea of something called compensating balances. This is a certain amount of money that must be left on hand with the bank to ensure that the bank will continue to lend you money. Okay, and so basically what a compensating balance is that it's a minimum amount that must be left on hand with the bank, because then, for instance, like if a bank was to say to you, oh, okay, you have a credit line with us of $5 million, but you must keep 10% on hand with the bank at all times. And the reason for that is because the bank doesn't want this company to just go ahead and spend all their money, and then the bank has nothing to left over to actually invest, or if the company has a credit line and they don't pay the bank back, the bank wants to have something to say, okay, let's at least somewhat cover ourselves, okay? And then the compensating balances are reported in the current asset section if the compensated balance relates to short-term financing, but it's reported in the non-current asset section, either in other assets or long-term investments, if the balance relates to long-term financing, okay? So if it relates to long-term financing, it's reported in non-current assets, and then if it relates to short-term financing, then it's reported in the current asset section, okay? And so it's very similar to the restricted cash part, okay, for the reporting of it. Then we have this idea of bank overdrafts, okay? A bank overdraft is basically when you spend more money than you have in your bank account, okay? So if you have $10 in your bank account and you charged up a bunch of things on there that were more than $10, then that'd be called a bank overdraft, okay? And the general rule is that bank overdrafts are reported as a current liability, but there's one exception, okay? The exception is that when a company has another bank account with the same bank in which there is a bank overdraft, then in this specific case, so you have two bank accounts with the same bank, okay? One of them is where you have a bank overdraft and then you just have another account. In that case, you offset the bank overdraft against the balance in the other bank account. Okay, so let's say you had bank account 1 and bank account 2 with, the First National Bank of America or something like this, right? Just some general bank. Okay, if in bank account number 1 you overdraft by $100, but then in bank number 2 you have $200, you just show this as an asset of $100. Okay, you just offset them. But if you didn't have this bank account number 2, then you would show this $100 as a current liability, okay, because there's nothing to offset it against, okay? Then we have a couple other quick points, and then we're going to go through a pretty comprehensive example of something that you might be required to know, okay? So a few other quick points. Post-dated checks and IOUs are classified as receivables. Then you have travel advances that are collected from an employee's salaries are classified as receivables. Finally, postage on hand is classified as a prepaid expense or supply. Okay, so basically a post-dated check is just when someone writes you a check, but they date it for, like, let's say they write you the check and you receive the check on, like, December 1st, but they date the check as of, like, December 5th or something like that. So what it means is you can't actually cash the check until December 5th. So you can't actually have access to those funds until December 5th. Okay, just as a quick clarification of what is a post-dated check. IOU is relatively straightforward. It's just like I owe you money, right? And so I owe you money is a receivable, right? And so that's basically a couple other quick points to somewhat just memorize, kind of just one of the few areas in this class where you kind of just have to memorize and be like, okay, this is a receivable, this is a prepaid expense, whatever. Okay. So now we are going to go through an example, and as it says here, it's a relatively comprehensive example, just to throw in a lot of different potential items that you might be required to know. Okay, so it says ABC Company has the following balances as of December 31 of 2018, and then we're given basically like what the item is, and then we're told the amounts. Okay, so our job is to determine the amount ABC would report for cash and cash equivalents on its balance sheet for the year ended December 31 of 2018. Okay, so what we need to do is go through all these items, and then we basically need to determine, is it cash or cash equivalent? And if it is, it will be reported as that. And if it's not, it's going to be reported as something else, and we kind of want to note that as well. So the first one is currency. Well, currency is cash, okay, so that's definitely going to be reported, right? Currency, it's literally just money, right? So that would be cash. Savings account, okay, First Bank of America, okay. Well, this one is so then we have to look down a little bit further for this one, for the actual answer, but we have savings account, First Bank of America, and then we have checking account, First Bank of America, okay? And so if we look at savings account, okay, it says $6,000, and if we flip back to our first page, we'll see here that savings accounts are one of the things that are considered to be cash, okay? So that's definitely going to be considered cash. But then, if we remember, we have a checking account at this same bank, okay? And it's for $4,000 negative, right? So that's actually a bank overdraft, okay? And so if we remember from at the bottom here, our rule is that generally a bank overdraft is reported as current liability. However, we're in the exception rule where we have two bank accounts at the same bank, okay, where the bank overdraft occurs, okay? And so in that case, we're going to offset the bank overdraft against the balance in the other bank account, okay? And so the other bank account is $6,000, and the checking account has negative $4,000. So what we will do there is we will just offset them, and then we'll show positive $2,000, okay? Then we have the post-dated check. That is a receivable, right? We just covered that one up there. So that's not going to be a cash equivalent, so we just put +0. So we've done these ones. Then we have commercial paper. That one is considered to be a cash equivalent. As we see on the previous page, it's commercial paper is a cash equivalent. Okay? So that's going to be included, right? Because we're talking about cash and cash equivalents. So we've done commercial paper. Postage on hand. We did this checking account just a second ago. Postage on hand, it says that's a prepaid expense, so that's going to be 0. Our compensating balance at First Bank of America. Now, the compensating balances, they don't actually affect the cash balance, so we're going to add 0. And the reason that they don't necessarily increase or decrease cash is because the compensating balance is already a part of the cash that you're holding at the bank, right? So if you had like $100,000 at the bank and the bank says, oh, you always have to keep $10,000 on hand with us because that's basically their rule. In case you actually are going to take out financing in the future, the bank has something to protect themselves against, right? They have, if you're taking out a credit line, if you have 10,000, or if you're taking out a credit line of like 100,000 or something like that, then the bank wants to keep a certain percentage so that way they can potentially cover themselves to a certain extent. Okay, and so basically, if you're keeping, if you had that credit line and then you deposit all $100,000 back into the bank, okay, the bank may require you to keep $10,000 on hand, right? This $10,000 is a part of this $100,000. Okay, there's still another $90,000 there at the bank. So this $10,000 doesn't actually increase or decrease your cash balance. It's just a part of the other cash that you have on hand at the bank. Okay, like maybe it's deposited in this savings account here or something like that, right? But it's not as if it's like extra cash. Okay, so that's that last. So that's that one doesn't affect. And then cash restricted for a plant expansion. This will be reported under long-term investments as cash restricted for plant expansion. So that's actually going to be 0 within cash and cash equivalents because we're talking about cash equivalents. We're talking about just the current asset section. This is going to be reported in the long-term asset section. And so it's not going to be reported in the current asset section. So if you were just total all these up, this one, and this one, we get 54,500 as a total cash and cash equivalents. So that's the end of this video. Some of this stuff is a little bit complex, but it's not too bad. It's a lot of it is kind of just knowing, okay, what's cash equivalent. But yeah, so that's the end of this video.